Welcome, ladies and gentlemen. Credit rating, oh my days. What do you want me to say to you? Moody's cuts the US credit rating. Is it something that's happened before? Of course it has. Go back to 2011, 2023, and before that. It's nothing new. When you've got a currency that is continuously being printed, at some point, you're going to have to just cut the reliability of holding its debt. Is this the best time for it? I mean, come on, man. You've got tariffs. You've got inflation, high interest rates. Even Williams, one of the Fed speakers, is saying the key word for the economy right now is uncertainty. And he threw in a little old wait and see with the data. But he did say that we've been getting quite a bit of good data on the US economy. Something's not matching up, man. It's just not making sense. Welcome to today's live, ladies and gentlemen. We start off the week with a very decent week. Like, we don't really have anything to worry about in terms of news announcements for the US dollar other than until Thursday, where we get a little bit of flash manufacturing data and, of course, the unemployment claims. But Monday, Tuesday, Wednesday is pretty much a free day to trade, guys. So the only thing that we'll be worrying about is good old dearly beloved Orange Man, or Mr. Trump. Now, just a few moments ago, I'm waiting for it to actually come into play, but Caroline's going to be speaking very, very shortly. So if we do actually see her talking, then we might actually jump into that and see what the story is. But our priority is to understand what's going to happen next. Okay, so we've got a very interesting story, to say the least, with this credit. I'm going to break down the idea of why this is a problem for investors in the US, but more importantly, investors overseas, why it's come at the worst time possible, given that Trump's trying to do something and then he's trying to put out some tax cuts, and Moody's like, hold on a second, you ain't doing the great thing right now with certain policies that you're putting forward and your management of debt. Your budget is all over the place and you want to start cutting taxes. It's going to be a very interesting week, to say the least. So what we're going to do today, guys, is just going to demonstrate the impact of a US credit rating cut. But more importantly, we're going to be focusing on what asset classes across the board are actually pricing that logic in. And I've got a little bit of a theory. I think that this credit cut itself is just to scare people off. It's not really going to have that much of an impact. I mean, historically, the market does drop on that. But given the current circumstances, I think investors have already priced in the idea of it going to the pan, as they like to say. You know what I want to say. But anyway, let's get with the program, ladies and gentlemen. I hope you've all enjoyed your weekend. Mad love and respect for everyone passing through. It's 9 o'clock, Tino. Stop rigging the market, please, and smash that live button. I'm already live. So let's get with the program, ladies and gentlemen, and make sense of this madness. Here we go. So, yep, this is what you're seeing. Treasury slide, stocks drop after US downgrade. It's all doom and gloom, isn't it, ladies and gentlemen? Is this a black swan? Clearly not. Moody's, Fitch, and of course S&P Global, they have all been waiting to do this. And I'm talking about a year right now, all right? They've been wanting to just put out the cut, and it's not something that no one's been aware of. It hasn't come at a surprise. It's just the timing. Timing is just a little bit off. You've got a massive change in monetary policy. You've got changes in the way we do trade, and they just thought, let's just add a little bit more to the plate. Now, going into the article itself, it does go on to say that equity futures have dropped and yield curve has steepened after Moody's ratings were stripped, and the US government of it stripped the US government of its top credit rating, citing a ballooning budget deficit it said showed little sign of narrowing. The last big meeting that Donald Trump had with the cabinet, if you heard Bessent, he did say we've actually extended or increased the debt ceiling, so we don't need to worry about that for a couple of years, which makes sense because over here you got Peter Schiff slamming Scott Bessent for ignoring Trump's tax cuts in Moody's downgrade. Now, look, the tax cuts themselves are going to generate roughly around $3 to $5 trillion over a 10-year period as such, but I mean, we need to sort out the problem right now. And the problem we've got right now is the interest rates. Now, just going over into the market itself, Euro, of course, welcomed that information. And listen, this is where I'm going to just dive into a little something right now and say to you all that why is this a premeditated move? I've got a little bit of a theory and I'm going to roll with it right now. So in front of you, what do you see? You see the euro, okay? Now, historically, the euro, since Trump coming into power, has started to become a safe haven. The usual suspects are the Japanese yen. Whoa. Here we go. Usual suspects are the Japanese yen, and of course, you've got gold itself, okay? So this is where investors say, you know what, I'm concerned about the economy. I'm worried about things. Shall I just put my money over here, okay? Now, with that being said, what's going on? Yeah. Now, with that, is the live okay, ladies and gentlemen? I don't understand what's going on here. Is the live okay? Can you just give me a bit of a hey, what is good? I just want to know if the live is working nicely. Yeah, it's working fine. Okay. So, safe haven investors, they go to gold, they go to the Japanese yen, and lately they've been going into the euro itself. All right. Now, why have they been going into the euro? It's pretty evident why, because money is cheap to borrow in the eurozone. Okay. Now, do you remember me saying that the only contender for the US dollar, or in other words, what could replace the US dollar, is the euro? An article came out about certain ECB officials have been pitching the idea that the euro as a US dollar alternative. This is why Donald Trump absolutely hates the euro, because it does compromise the US dollar. In what sense? Well, if you look at the dollar dominance, it's made up of a basket of assets. Okay, so you got the euro, you got the yen, you got the pound, the Canadian dollar, the krone. So all of those assets are paired against the US dollar. Now, the euro being the main one, where it takes up around 56, or it makes up around 56% of the transactions on the dollar dominance. You got the yen in second place at around 17%, and then the pound coming in at third with around 9 to 11% of the transactions that happen for the dollar dominance. So you can see that most investors are transacting on euro and dollar. That's where the money's at, okay? ECB officials are pitching the idea that they could use the euro, or the euro could be put forward as the new world currency reserve. Not that it will happen anytime soon, but it's starting to show attributes of being the worthy candidate for it. So you've got a credit rating cut by the main credit rating agencies. That is going to really wind up Trump. But more importantly, it now shows you that investors are going to demand a higher rate of return on long-term dated and short-term dated securities. Let me explain. So what's the long-term dated security and short-term? That's your yields. Right now, the US bond market has been smacked, and it's just getting worse for them. Right now, Druckenmiller, the big hedge fund investor, he's been running shorts on the US bond markets for quite some time, and that was before Trump even started to rally for presidency. So he's doing all right in this play right now. Now, with this Moody's cut, there's going to be an initial reaction from the marketplace, but I'm going to get to my story about what I think is being sinister about this play. The yields market itself, look, 5-year yields coming up at 4.14%. The 2-year yield is trading at 0.65%. The 10-year is coming in at 4.5%, and the 30-year smashing that 5.02%. Do you understand? When you're getting 5% on a 30-year, that is brilliant. The ideal sweet spot is the 10-year being at 5%. That will cause madness in the marketplace because investors would love the idea of being able to lock in 5% on a 10-year bond. The problem we've got is this. The bonds market, in principle, tells you whether or not investors favor the long term. As it stands, they don't. Why? Well, you've got tariffs, you've got inflation, you've got this inconsistency behind whether they're going to cut the rates or not. We know, as we just quickly update it, we go into the Fed Watch tool in the next 30 days. The Federal Reserve is going to be meeting again. And as it stands, we're still at the 91.4% for the rates to stay at 4.25, 4.5%. In regards to the next meeting from that going into July, we've also got the same, pretty much the same reading. Look at that. It's now at 66.9%. Well, that is very interesting. So the bets are changing going into September. Yeah, man, they've changed that. There is still an expectation of the 4.25, 4.5%. So yeah, you can appreciate that investors are pretty much on the idea that the Fed's not going to be cutting the rates anytime soon. Williams this morning did say that they are only probably going to cut the rates once. What kind of cut we're going to get? At minimum, we're going to get 25 basis points, or we're going to get a jumbo cut where we could get nearly 3 basis points, where like 75 basis points, sorry, on the interest rates. But based on the way the data's coming out, it's saying that the US economy is okay, but from a credit rating perspective, it isn't. Now, before I get into my idea, in front of you is Tuesday, the 1st of August, 2023 article when they last cut the ratings for the US, okay? Now, I've been trying to find the article, but there was an instance when they cut the credit rating, and then Congress came up and said, can you not do that, please? Because it's detrimental to our book, all right? And then they changed it back. I can't find the article, but I remember I spoke about it in the live streams back when it did last happen, okay? I can't seem to find it, but there was an instance when they cut it and then they reverted it back because it's not looking good for investors. And that is evident with the fact that the 2 years and the 30-year and the 10-year are still trading higher. So what's my story? My story is this. If the idea that you've got this credit rating cut is meant to scare investors off, where's the representation of that? So we know safe havens, gold, euro, and yen. Yeah? They should be really pumping up. Let me explain something. Look at gold. Gold is currently stuck in this consolidation. It's being very, very choppy. Okay? But gold investors are trying to work out whether they should stay in safe havens or not. Already, the marketplace itself is a little bit concerned about where to put liquidity. I mean, if we just go over to the NASDAQ, hold on a second. We've just had some news. China issues statement on US adjusting chip export controls. And Vance has said, if Russia's not willing to engage, eventually the US has to say that this is not our war. Okay, at least the US ain't going into war. Anyways, so fundamentally, gold should be going up on the back of this story behind the US credit. Why? Because there's no point in sitting in dollars right now, is there? Look, going to the dollar market, it's taken a nosedive to the downside. So investors in principle should be going over to gold because cutting the credit rating for the US means investors are no longer going to be buying US debt, which means that they're going to seek a higher rate of return on holding this US debt, which will naturally have an impact on the tech market because the tech market is subject to changes in interest rates. Okay? So I'm looking at it and I'm saying to myself, so where's the NASDAQ in all of this? Well, look, you would assume that the NASDAQ is getting ready to roll over. You got these green vector candle regions right here. It's made a little bit of a move in sweeping the Asian session. And if we actually look at where the NASDAQ is in relation to the stock market as such, you've got here, it says exposures between 80 to 100%. So that means if you're an investor right now, you should be committing around 80 to 100% of your portfolio or cash into exposure in the stock market. Happy days. We don't have any days where the market's selling off aggressively. So if we just have a look at the accumulation and distribution rating for the stock market, you can see over here, look, all we've had is 7 positive trading days. And out of those 7, 5 of those days have been above average volume. And it's trading above the 50-day, which is this red line right here. We've had one day where it's been trading negative, but the price action at the top right, you can see that little candlestick right there. It's pretty much evens. So that kind of tells me that there is possibly strength in this move to the upside, which then leads me over to the idea as this. Is this news about the actual credit rating cut already been absorbed? Have they already priced it in? Do they already know that it's a problem? Now, Trump and these tariffs is designed to generate income coming in. So you're really making money. And I know tariffs are deflationary and whatnot, but the impact of it is going to naturally then hit the consumer. And the consumer is going to represent that by saying, you know what, I'm not going to be paying for those goods. I'm going to claw back a little bit. And then the economy starts to slow down because people aren't spending money. And then if you do add water into the mix, you can then turn around and say, if the unemployment data shows that people are still working and less people are claiming benefit, you've got a sustainable economy. And if the manufacturing data does suggest that things are going to be contracting, then it only means it's just companies actually getting ready to adapt themselves to the changes with these tariffs. Now, for me, Trump hasn't mentioned anything about these tariffs. Today, he doesn't really have anything scheduled in the calendar that we need to be concerned about, but he has got freedom to speak, okay? So today we had Caroline Levitt speaking. I don't know if she's speaking right now. China's actually just come out saying that they're asking the US to correct the wrongdoings. So yeah, we'll dive into that, and that's what's led the market to make a little bit of a movement. But Trump right now has got 3 instances in this calendar of his where he could say something. So at 3 p.m. today, Eastern Standard, he's going to be participating in a bill signing. He's going to say something. He's bound to say something. This guy does not stop. He's going to say something. And then the president participates in the law enforcement event. He's going to say something. And then, of course, he's going to be going for a dinner at 7 p.m. So I'm looking at the times that he's going to say anything, and they're all close towards the end of the trading day, which is no good for us because we want him to say the information now so that the market can absorb it and start making its moves from that. So I would be careful around 3 p.m. Eastern Standard Time to 7 p.m. Eastern Standard Time when Trump's going to start talking. So if you do have exposure in the charts, just be very, very careful. But what am I saying about this whole story? I actually believe that the credit rating thing is nothing that we need to be concerned about, okay? Because the market hasn't been developing into the idea of it being concerned about it. Williams today said that there is going to be a rate cut, so investors are forward thinking. You've got other aspects to it as well. Let me just show you something. In front of you is this chart. Now, this chart right here is the credit spread, okay? And it's in relation to this spread reflects the market's expectations of future corporate default risk, okay? So why would you need to care about future corporate default risk? Well, corporate companies, they're going to be buying US bonds or not. And if they don't have the money for it, then they're not going to be buying it. That's a problem for the bonds market in principle, okay? But without diving too deeply into this, as long as there is a tight spread between the credit, and then you've got US BBB credit spread and AAA credit spread, as long as there's a tight spread between these two, everything is all good. And that's what we've got right here. So credit spreads are tight. The only problem that we've got is there is a spread between the bonds and the yields market, okay? So what you've got to say to yourself is this credit rating story designed to push the yields up so that investors can lock in decent rates of return right now? Because when you look at it, stock bond ratio says that stocks are overvalued in comparison to the bonds. And usually when there is a clear distinction between stocks being overvalued and bonds being undervalued, that's when things start to turn, which means that bonds would then start to come back up and stocks in principle would start to correct. By how much is where the magic of trading is and investing is. In other words, can you absorb the retrace until there's that relationship again where the bonds and the stocks ratio start to meet in the middle, where investors are like, okay, we feel like now that the bonds are beyond undervalued, let's start selling them and start going into higher risk. For me, it's the yields. If the yields start to pull back, that means investors are starting to get into the US bonds because they want to lock in these high rates, okay? If they're locking in the high rates right now, because look, 5%, investors do not want to miss out on a 5% 30-year. So naturally today, I expect the yields market to start pulling back. I then expect the US bonds to start trading positive. I would then expect the volatility index to start coming back down, which would then in principle start sending everything back up. That includes your NASDAQ, your S&Ps, your cryptos, well, not so much Forex, but I would be expecting Euro to come back and correct. Why? Because if you consider where Euro has been right now, on the back of this credit rating cut, investors have effectively gone into Euros because it's an alternative investment as opposed to going into US debt. I don't trust this move. I don't believe it's a valid move to the upside in the euro. Not to say that investors aren't going into euros. It's clear as day that they are. If you just go over to the bonds market itself, you can see that they are starting to go into shorter term dated securities where the yields on the 1 year are coming down, 2 year coming down, and then you've got the 6 month it's coming down as well. So when you see the yields in the Eurozone coming down, it's because investors are buying European bonds because it's much safer to do so, okay? But what I'm trying to convey to you all is I don't believe that this credit rating story is going to impact the marketplace, because if it really did, gold would be shooting up because it would naturally then encourage the US government and, of course, the Federal Reserve to do something about the fact that they've got high interest rates. So how do you restore confidence in investors? By making sure that you give them everything that they need to justify purchases in the bonds market. So how do you do that? You effectively offer higher rates of yield, and then once they hit those yields, that's when investors will come in and start buying everything. But we know that they're not really scared about it because gold fundamentally should be going to the upside. Euro made the move, but gold should be making a move to the upside off the back of the idea that investors are concerned about the US dollar. But they know that they're going to be cutting the rates in the future. Maybe this is going to put them in a little bit of a problem because they know that they're not going to cut the rates anytime soon. And Williams today said that we're probably only going to get one. So where does it put Bitcoin? Well, in the scope of Bitcoin, this has come out about MicroStrategy. 5.9 billion Bitcoin loss, but they still go and buy some more. All right. Now, I've said this to you all before. Okay. And some of you are all going crazy about it and challenging me about it. Wall Street will always behave like Wall Street. What do I mean? All right. Look, MicroStrategy as a stock prior to them changing their name and changing their whole business model. See, now it says provides Bitcoin Treasury services as well as an analytics software platform for various industries. That's what it does. It's an analytics software platform for various industries. Now, fundamentally, this stock is dog. And you've been hearing me say that it is dog. Now the proof has come into the pudding with this article. They're trying to put a class action lawsuit against them because they're saying that they're coming up with random yields and they're not going anywhere with it. But they still hold a lot of Bitcoin to the sum of, where is it? Here we go. 576,230 Bitcoin is now valued at around 59 billion. So regardless of whether or not that their fundamentals as a company are dog, well, the investors should really consider that, because when they were offering convertible bonds, investors were all basing it on their Bitcoin holdings. Now their Bitcoin holdings not value, but the yield is being challenged. So they want to be investigated. That might actually lead Bitcoin to pull back ever so slightly, but their earnings that they came out with not so long ago didn't really satisfy investors. They achieved a minus 1,892% on their earnings and minus 4% on their sales. And there's no such thing as a price earnings ratio or even earnings per share. So you earn nothing holding this stock, and you actually rely on the fact that their Bitcoin holdings are going to end up sending their stock price higher, because more and more people are going to come and buy these convertible bonds. And then those bonds are going to end up being used to go and buy Bitcoin stock per se, right? So that's the justification for why anyone would buy MicroStrategy stock. In my opinion, you either buy the ETF or you either buy Bitcoin itself. I personally wouldn't entertain it, because Wall Street will always go back to what it does, and it looks at the fundamentals, and this is a classic example of it. And investors pretty much want to say, you know what, screw this. We want to know what the story is. We're not happy with the way things are going. Now, with that being said, ladies and gentlemen, let's just go into Bitcoin price action right now, just to break it all down and understand what on earth has been going on with Bitcoin. So, the weekend, it makes a nice little pump to the upside, sweeps out all of this range, and hits quite a few short liquidations. So let's just go over to the liquidations chart. Where is it right now? Here we go. So look, they ate all of those liquidation points right now, and they've now started to come back down, and there is the potential to eat these long liquidation points right here. I mean, you've got a lot of longs right now that are kind of concerned about, what the hell? Here we go. So you've got some longs down here that are kind of concerned about price action. They're probably adding their margins to the chart. But what I like to look for when they go for liquidity is this. You can see how they've gone for the sweep here. So that's one sweep, which has effectively led to an attack to the upside. Then you've got another sweep here, and then you've got this little sweep down here, which has now led to a little bounce. If Bitcoin can hold this zone right here, which sits at around the 102,000, then there is the idea that there could be a possible reversal to the upside. The only logic that I've got that there's going to be a reversal to the upside across the board is Aussie yen. That's all. you know? Aussie yen. Now, Aussie yen's creating a little W formation. Why am I so concerned about this Aussie yen? Because Aussie yen works on the principle of a carry. That means they exchange yen or dollars, put them into Aussie, use Aussie to buy stock, to buy Bitcoin, to buy whatever it is they want. And if you go back and look in the charts, right, if we just add the NASDAQ to it, because I know you've seen me do this before, based on the way the NASDAQ behaves and the way the Aussie behaves, you can see that there is genuinely a positive correlation to this asset class with the NASDAQ because it's the carry, okay? Because what they're doing is they are buying Aussie dollars and using that to buy stock, to buy Bitcoin. So when you see Aussie yen consolidating and creating a pattern, right, and looking like it's getting ready to mark higher, the logic is that they're consolidating in this range. And the principle says that if Aussie yen's going up, the NASDAQ should be climbing up. So naturally, you do want the dollar to go down because you want to know that they're transacting on dollar to get that into Aussie and then put the Aussie to work. And then the NASDAQ should be moving up, which makes sense because you'll be asking yourself, hold on, if the dollar's going down, why would investors be buying the US stock right now with weak dollars? It doesn't make sense. It means that would have to buy more. Okay. They'd need more dollars to put to work. They're using Aussie. And that's where you can identify if there is a disconnect right now with Forex. There is a clear disconnect in foreign exchange because things aren't behaving the way they should. Since when has the euro ever been a safe haven? It's never been a safe haven. But all of a sudden now it is because the rates are low. So it means it's cheaper to borrow money. You're getting much more better rates of return on the CME implied rate swap differential. So you're earning 5.6%. You earn less in a US bond. So better go over to the euro and start taking advantage of that. They're plowing their money into Aussie, in my opinion. And they're going to use Aussie to then put that to work in the stock market. So if any of you that are involved in Forex, paying attention to Aussie yen is going to tell you whether or not the stock market is going to be trading upwards and whether or not investors are in the carry trade right now. Because you've got the yen carry trade, which is exchange yen to dollars, put those dollars to work, and then start buying stock, right? Right now, we've got the Aussie yen. In my opinion, they're using Aussie right now and using that to go into the stock market. The only way that that logic would be invalidated is if they break down below 92. So you can see that they're spending a bit of time here. Does that make sense, ladies and gentlemen? That should then lead us to the logic of why Bitcoin might not be done right now. Get rid of that. Happy days. Any questions before I go into the daily time frame? Remember, never trust the weekend pump or dump. Weekdays only is the true action. This is very true, my friend. Yeah, this is it. USDT dominance is looking like it's found support and is getting a bounce. Probably is. Okay. But let's just go over to the higher time frames on Bitcoin because I know that's where people's brains are at. Have we got anything to worry about? Well, you could assume so. They've come back and taken this little strong commitment right here, but we're going into a bid area, okay? Now, this bid area is from this range right here, and then you've just taken these little bid zones, these wicks. So this is where interest is, okay? Going to the order flow of Bitcoin, you can see that we've got quite a few players right now that want to try and take advantage of Bitcoin coming down. And I'm going to be straight with you. I'm looking at the order flow. They're really putting down money, man. They are really putting it down. Look, 18 million, 60 million, right? And that was on Bitcoin's drop. They're buying up Bitcoin in this range, ladies and gentlemen. They're going for it. So that tells me that there is an expectation that in the future, Bitcoin is more than likely going to start making a move to the upside because of the concentration of bids that have been coming into play inside of this range. Like, that is just absolutely wild. 60 million, 18 million, big boys are coming in. From a holder's perspective, Bitcoin has just broken the 5 EMA, right? At the end of the day, based on where this candlestick forms or finishes, is going to dictate whether or not Bitcoin can actually continue higher. Because the problem that we've got is this: Bitcoin tends to create a range after it makes a move, and it ends up staying in that range. Now, a lot of people are like, oh, Bitcoin, the altcoin season and all that stuff. Your Bitcoin dominance ain't done, ladies and gentlemen, and Bitcoin's going to keep on going up. They're going to come back up to the 65 region itself. That's my logic. Just go into the 4-hour time frame, and you can see that they're leaving clues, and it's also a very, very controlled move. Look at this. This dominance that has been going down has been a controlled move to the downside. So in other words, investors are trying to go over and take advantage of maybe some altcoins and what have you, take some money out of Bitcoin, go and put it elsewhere. You don't know exactly what they're doing. But in my opinion, the Bitcoin dominance is going to shoot back up to its highs of around the 65 mark. And there is a possibility that Bitcoin does continue up. I'm looking for maybe, possibly a 70% Bitcoin dominance. Why? It's just too much, ladies and gentlemen. Look at your Arkham with the ETF. The balances are growing and they're getting crazy. 632,000. This has gone up from 626,000 from yesterday. It's clear as day that they are accumulating quite a bit of the Bitcoin ETF. So as long as that's happening, and unless Ethereum becomes an ETF, unless Solana becomes an ETF, and unless XRP becomes an ETF, violation that was, but it's all going to Bitcoin, okay? And a lot of people are trying to work out that I'm going to go into my altcoin season and what have you. Fundamentally, Bitcoin goes up, everything goes up. I don't think anyone's going to sell their Bitcoin, given the actual amount of hype and optimism there is with Bitcoin across the board. I don't think they will sell it to go into altcoins. I might stand to be corrected, but you know, for me, Bitcoin, there's too much press behind it. There's too much hope behind it. There's too much, it's going to do it in the end kind of mentality. And that's what you've got to take into consideration. So when you look at the daily time frame on Bitcoin, you might look at this and think, oh my God, I got shaken out and what have you. Look, unless Bitcoin invalidates the 100,826 region, which is the last area that it wicked from, we have nothing to worry about. And it's so close to its all-time high. You're going to get another all-time high, guys. You are. It's going to sweep this 109 like no tomorrow. And that's what I'm saying about this whole downgrade, because it's effectively going to encourage investors overseas to not invest in the US. And Trump doesn't want that. Why do you think everyone keeps on talking about the US economy being good and the bond market being great, and that we don't need to worry about anything because this new monetary policy, fiscal policy that's coming out from the administration is actually great and it's going to start the golden age? They're practically trying to sell you bonds, okay? They want you to buy it because they know that the expectation of the future might not be great if they have to refinance debt at higher rates. So they have to get these yields down. But Trump's caught in that story of tariffs. He can't really back down now after he's been Mr. Big D thinking, yep, you ain't going to do anything. These tariffs are here to stay. But I think the big market catalyst will be the tariffs on the Eurozone. You thought it was China. It's actually the Eurozone, because there is nothing being spoken about these tariffs. And the Eurozone is the only one realistically that's coming out saying that we've got countermeasures to these tariffs. So that, in my opinion, is going to be the bigger market mover. China was just to shock everyone. All right. In the end, they were always going to make sure it was good with China. But the euro and the dollar, that really does grab investors' attention, because if they're not buying if they're not buying US debt, they're buying European debt. Trump needs to make sure that he gets everyone's money over to the dollar. It's all going to be down to what he says about the Eurozone, in my opinion. Any other questions, guys? Any other questions? Now, how many of you are new to this live stream? If you are new to the live stream, mad love and respect for passing through. Get yourself over to tradersreality.com, because I've got a free PDF that you really want to get involved with to help you understand this system we use, which is the hybrid system, and helps you understand these vectors. But if you haven't got the indicator, the Traders Reality homepage will show you how to install it. Scroll down, join the Discord, and watch this video because it shows you how to install the indicators. It's because the indicator is free of charge. You just click these two things right here, takes you straight to TradingView. Make sure you like it, favorite, and all that stuff, and you'll get the indicator free of charge. Okay. Anything else? There is no asset on earth that is as perfect and as pristine as Bitcoin. That is never going to change. Slowly over time, the big boys are going to price you out of the market. That's the problem. You don't want that to happen, but it already is. There's your heist. I've said this before. Bitcoin heist is happening right now. They're taking it all up, swallowing it all up. We've already got corporate America holding more Bitcoin than Satoshi. It was like, who would ever hold that much Bitcoin? Your ETF is near enough on its way. You know? Anything else, guys? Anything else? Have you liked the stream? No, you haven't. There's only 1,600 of you. Sorry, there's only 390 of you have liked the stream. Where's the love, man? It's starting the crypto week, trading week. Come on. Where's the love? Tino, what if you just had you as an indicator? Probably. I'd think I'd be a great indicator. Can I buy oil on BTCC? No, you can't buy oil on BTCC, but you can trade all other assets on BTCC. You can trade it with crypto. You can trade crypto. You can trade NASDAQ. You can trade Forex and tokenized stocks. So if you want that platform, just go in the description of this live and it will take you to that page. Tina, will you be my indicator? So all things considered, up or down? Peter, not impressed. Not impressed. Look, quite frankly, ladies and gentlemen, like I said this morning, earlier on, this debt ceiling thing has got everybody like, oh my God, the credit has been done. But they've been trying to put this out for a whole year. You don't think the big boys already know about the credit rating? No one even paid attention to the fact that Bessent said in the cabinet meeting, we've increased the debt ceiling so we don't have to worry about that for another 2 years. No mention of it. There was none. It's there in plain sight. But people are too focused on other things. That's not people's fault. It's just the narrative that is being spun. But the charts do give you the clue. If gold isn't pumping up and investors are scared, it means that this information is actually dog. Hold on. It says here. Oh, no. Here we go. Fed's Jefferson. Because we've got a lot of speakers coming out. It says the downgrade will be treated the same as other incoming data, with focus on implications for jobs and inflation. And a meeting between Putin and Trump is not being prepared at the moment. Okay, so Jefferson's coming out saying the downgrade will be treated the same as other incoming data, with focus on implications for jobs and inflation. They've already downplayed it. They're not bothered about this downgrade because they know they can turn around to them and say, put it back up. There is that article. Please, guys, do your thing on the internet. Either go into my live streams from before where the credit rating happened. I'll give you a focal point. I think it's around August 23, August the year 2023 when I spoke about it. I just can't pin it down. But the US came and Congress came out and said, change it because it's devastating for our investors. And they reverted it back. It says on the internet that there's no history of them retracting back or reversing their rating. But they did because we spoke about it. But it's not being mentioned right now. So, yeah, don't worry too much about this credit rating. Like, it's the US dollar, man. People still need it. They still use it. And it will always be the world currency reserve. Whether it's a dead rating or not, you can't change people's nature. The legacy markets are the legacy markets because people only know those asset classes to perform during times of uncertainty or great news and what have you. You can't kill their idea with a credit rating. It's pointless. And I guarantee Trump will just snub it off. Bessent won't even be bothered about it. But it all depends on how high the yields go. That's the thing. Anyways, 70% Bitcoin dominance would lead to what? ETH 64-ish. Tino, is 100K in the cards before the all-time high? When it gets to it, then you'll know the answer to your question. And that's the truth. My long is printing, Tino. You got to get a cover up for that ugly portrait of yourself on your forearm. Oh, well, never mind. What a guy. These are the same credit rating agencies that said Greece was good to go into the euro. You see what I mean? And look what happened there. What's the NASDAQ doing? Let's have a look at NASDAQ. Told you. I literally told you what it was. This is the story. Get the yields to a point where investors will be happy. Let's lock in those yields, man. Yippee-ki-yay. And I bet the euro is taking a little bit of a tumble. Yeah, it's on its way. And Aussie yen, bingo. There she is. Do we get it? Yeah? Mad love and respect, ladies and gentlemen. And I'll be tuning into you all later. Peace.